Impala Platinum's full-year headline earnings per share fell by 22% as the stronger rand cut sales and as a result of the impact of both the tragedy at its number 14 shaft and industrial action at the beginning of the period. Notwithstanding the decrease in headline earnings, Impala boosted the total dividend for the year by 22% to 390 cents a share. Alishia spoke to Impala Platinum CEO David Brown.
Well, I think there's very little we can do with regard to the rand. As I say, we are generally price takers, and the price takers not only includes the dollar metal price, but also the rand-dollar exchange rate. I think overall we've been buoyed by slightly better dollar metal prices over the previous 12 months, and that's obviously helped to improve, or shall we say trim, some of those anticipated reductions in our HIPs. But having said that, the rand has had a marked impact, particularly in the latter part of the last financial year. I think going ahead at the R7.30, I wouldn't say it's necessarily the most comfortable level. And in fact, our rand basket price now is probably around the same region as it was just pre the Eskom crisis, which was, as you remember, in early 2008. So it is having a marked impact. I think one of the benefits we obviously are getting is that we are getting lower cost inflation come through in terms of our consumables. And in fact, in the 2010 year, we saw consumables decrease by about 5%. So there are some positives, but obviously we are far more geared on the revenue line to the rand. As far as weakening it, I'm not necessarily an advocate of weakening the rand just for the sake of weakening it. I think what we do need to do is we need to make sure that we obviously trim our cost line and we actually look after and protect margin by being very vigorous on costs and improving productivity.
So let's take a look at those input cost side. I mean, unit cost per platinum ounce up 11% for the full year. I mean, what drove those prices higher, and what's your target for 2011?
Well, I think with regard to the 11% increase, as you might be aware, we started the year off on a very difficult note. We had the 14 shaft tragedy where 9 of our colleagues regrettably were killed, as well as a 2-week industrial action. If we kind of normalise the year in terms of assuming those events didn't take place, our unit cost would have increased by only 5%. So I think in terms of that probably does reflect a good underlying cost management. So I'm pleased with the business in terms of that. In terms of setting targets for next year, I think one of the difficulties we have is obviously wages. Wages make up about 55% of our total cost base. And I am obviously very concerned that we continue to look at real wage cost increases without necessarily seeing improvements come through in productivity. I think we're probably anticipating somewhere in the region of about 8 to 10% again next year in terms of a unit cost increase, largely based on the increases that have already been signed last week with regard to wages.
Well, it's in this very challenging environment at the moment that we've still got a divvy of 390 cents being declared. That's serving to reflect some of the optimism you show moving forward. I mean, from your end, and the confidence in being able to hit targets moving forward. Some saying, though, it may well be an overconfidence in a very volatile market. Why that decision to pay that divvy?
Well, I think there's 2 aspects for us. One is we've maintained a very strong balance sheet throughout the process. In fact, we're still net cash despite the economic crisis. We've maintained our capital expenditure program, so we haven't cut back. That capital expenditure program is still going to support a 2.1 million ounce production target by 2014. So all the building blocks are in place. Why are we confident? Well, quite clearly we're confident in the medium to long term future of the PGMs. I think we are going to see some additional volatility and some recessionary pressures through the rest of 2010 into 2011. But I think one has to always bear in mind, as a miner, we're a long-term business and we have to look in terms of what we believe the long-term pricing environment will be. And the long-term fundamentals are very positive. So hence it's a reflection of what we see in the medium to longer term.
So when it comes to that capital expenditure program, I mean, you're maintaining a very ambitious program there. When it comes to funding that program moving forward, is it still going to come from your operating cash flow still, or have we seen a bit of a shift in that regard?
No, we're still quite confident that the bulk of it is going to come from internally generated cash flows. Having said that, the first question you asked me with regard to the rand-dollar exchange rate, obviously if the rand continues at this sort of level, quite clearly we might have to look at some additional borrowing, but I can say that it's immaterial in terms of the context of the overall group funding.
In terms of production itself, I mean, we've had production up 2%, that a marginal gain, and analysts still seem to believe that Implats is not hitting its full production potential. We know that, we've got various issues plaguing production, industrial action being just one of them. Are we looking at realistic targets being set in the first place?
I think we are, absolutely. Quite clearly the difficulties we had in Impala Rustenburg vis-a-vis our production output for 2010 was obviously marred by, as I say, the safety issue that we had at 14 Shaft, as well as the industrial action. We signed our wages agreement this week, so we don't anticipate industrial action, so we will not see a loss of production coming through from that particular element. We have obviously spent a lot of time concentrating on our safety issues. We've had various reviews take place, and we're going to be incorporating various lessons that have been learned from those particular issues into our safety targets, and quite clearly we'll be looking towards a much improved safety targets for 2011. So both of those items should be stripped out of the overall production decline we saw in 2010. I certainly believe that longer term, we're obviously sinking 3 major shafts at the moment. Those 3 shafts will start to come on. The first one will come on in 2011, the next one 2013, next one 2017. That will provide a stable base load. So certainly we believe the 2.1 million target is well achievable.
So that's the operating environment here in South Africa. The environment is somewhat different in Zimbabwe, far lower operating costs because the Zimplat's operations are shallow and mechanized compared to deep level labor intensive South African mines here. In May we heard Implat's reveal that it was going ahead with its $500 million phase 2 expansion of its mines on that end. Let's talk investment strategy there in Zimbabwe, and what's the appeal looking like at the moment?
It's a fantastic ore body. It's the second largest known deposit of PGMs in the world. We obviously are very lucky that we have a preeminent position with regard to that particular ore body. As you quite rightly pointed out, some of the positives are the shallow, quick entry, and also a well-trained, well-educated workforce, coupled with the fact that the capital requirements are actually relatively light compared to some of the deeper level capital requirements that we are having to look at in South Africa. So the appeal for me is obviously we have been doing it on a modular basis. In other words, we recognize that there is a risk associated with the investment there, but what we try to do is mitigate and manage that risk as best as we can. And certainly one of the strategies we've used is by actually doing those expansions, but in what we call modular fashion, with minimal or optimizing the amount of capital that is required. As I say, it's about 450 to 500 million for additional 90,000 ounces, which will be delivering by 2014. The MPV and return for shareholders, even on a risk-adjusted basis, is extremely attractive.